your final session with House of Coffee, you'd like to inform the owner on how he can calculate the degree of operating leverage, or DOL for short. This ratio helps determine what the impact of any change in sales will be on House of Coffee's profit. Does House of Coffee want a higher degree of operating leverage or a low degree? Well, we go back to risk and return. The higher the DOL, the more operating income will increase with increased sales levels, but the more operating income will decrease with decreased sales levels, decreasing so much that we may suffer a loss. So, how does the owner calculate this degree of operating leverage, and what does it mean to House of Coffee's bottom line? That's the big question that we'll answer in this lesson. We learned that operating leverage is the degree to which operating income responds to changes in sales revenue. We can calculate the degree of operating leverage, or DOL, using the following formula: total contribution margin divided by operating income. Let's look at the two scenarios of House of Coffee to compare what changing the cost structure does to the degree of operating leverage. First, our original structure with $5 million in fixed costs. So let's plug in this information to our new DOL formula. $6 million in total contribution margin divided by $1 million in operating income. That equals to 6. That's the degree of operating leverage, or 6 DOL. Next, let's see what happens if House of Coffee still realizes $1 million in operating income, but they restructured reducing fixed costs by $1 million and shifting it to variable costs. Now we plug in this information to our new DOL formula: $5 million total contribution margin divided by $1 million operating income. That equals to 5. That's the degree of operating leverage, 5 DOL. You can now show the owner that the DOL is higher when fixed costs are higher. And again, higher leverage means higher returns in thriving times, but higher risk in leaner times like a recession. The 6 DOL tells us that the total contribution margin must change $6 for our operating income to change only $1. The lower DOL of 5 means that the contribution margin only needs to change $5 to get the same $1 change in operating income. Now that we know how to find the DOL, we can use it in another DOL formula to see how operating leverage impacts operating income as a percentage. Degree of operating leverage multiplied by percentage change in sales equals percentage change in operating income. So let's say that House of Coffee had a 20% increase in sales. Based on their DOLs, we can find the percentage change in operating income. So let's look at the original one first. 6 DOL multiplied by 20% change in total sales equals 120% change in operating income, versus the restructured calculation of 5 DOL multiplied by 20% change in total sales equals 100% change in operating income. In other words, under the original cost structure, if House of Coffee sold 1.8 million large cappuccinos instead of the 1.5 million, their operating income would increase from $1 million to $2.2 million. That's a 120% increase. And likewise, under the restructured scenario, selling 1.8 million large cappuccinos would increase the net operating income from $1 million to $2 million, a 100% increase. We can see the higher DOL at 6 means the change in sales has more impact on operating income than the lower DOL of 5. Hello, certified professional. If you are enjoying this course, get accredited with CPE credits for watching it. Click the link in the show notes or visit cpeflow.com to access the full course ad-free and pass the final assessment quiz to officially earn your NASBA approved CPE credits and certificate of completion. So, of course, To the owner, it's a no-brainer. Stick with the original structure with higher fixed cost, which is higher return. But you remind him that operating leverage has returns in fruitful times, but risk in lean times. What if the 20% change was a reduction in sales instead of an increase? So let's apply it to our 2 DOLs in that scenario. Under the original structure with a 6 DOL, if House of Coffee sold 1.2 million large cappuccinos instead of 1.5 million cappuccinos, their operating income of $1 million would decrease to negative $200,000 loss. Now, with a restructured approach with a 5 DOL, selling 1.2 million instead of 1.5 million large cappuccinos would change their operating income of $1 million to break even without a loss. That's a huge difference. So based on our new understanding of DOL, here's your advice to the owner. You suggest the owner make changes to operations so he can hit the restructured cost structure target with less fixed costs for the coming year because we expect an economic recession. This is how House of Coffee can best prepare for the coming recession. And here we are. It's already time for you to part ways with House of Coffee. It's been quite an adventure, hasn't it? When you first found out about this company and met with the owner, you were looking at a company that was stuck and felt powerless in the face of an economic recession. A business that seemed exhausted and infuriated by the past 3 years of a global pandemic. But the company you are leaving today is in good shape to continuously flourish in the near future because through these numerous lessons, House of Coffee has learned that no matter what the company will face in the future, they will be ready to make informed financial decisions that will impact how well the company can get through good and tough times. With this entire course, House of Coffee has learned to use CVP analysis to determine how changes in selling price per unit, your variable cost, fixed cost, and sales volume affect the company's operating profits. With your help, House of Coffee has learned to stay profitable through every season, including the somewhat expensive holiday season, and make informed decisions on their price points, including unit margins and contribution margins. They also learn how to understand fixed and variable costs and ultimately how to minimize them. With the CVP analysis, House of Coffee is able to not only see where the company currently is and where they want to be, but how to actually get there successfully. You have helped this company answer some of its most critical questions, identify its leading product, and understand its main cost classifications. Additionally, you've equipped House of Coffee with rules for them to either play it safe or take bigger risks when time allows. And with your help, House of Coffee is now more prepared to weather any storm. And that's what CVP analysis is all about, giving confidence and power back to businesses and to its business owners.